Welcome to Drill Down Earnings. We have quarterly results out from onsemi. Not a good quarter. This is the business story behind the stock on the move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. We look at the 50 most important companies in technology. onsemi is certainly one of those. A giant chip maker focused on automotive and industrial. Specifically within automotive, they're focused on electric vehicles. So they reported Q1 earnings, and while they beat Wall Street's estimates, this is exactly why we don't focus on Wall Street's estimates, because Wall Street's estimates expected a really terrible quarter. It was only a slightly terrible quarter. Is slightly terrible even a thing? So they had 1.45 billion in revenue. Wall Street expected 1.4, but still 1.45 billion in revenue was a lot less than what they had last year. In fact, 22% less in revenues than they had a previous year, principally because of a collapse in their automotive business. So let's talk about what we saw. So again, 1.45 billion in revenues, GAAP gross margins of 20%, non-GAAP of 40%. They were, when we dig a little bit deeper beyond the headline numbers, what we see is that they took a huge restructuring charge of over $500 million in a quarter, and that wiped out all of the profits from this business. Lots of people want to strip out that number and look at how the business did. It did a little bit worse than it had been doing, but you can't strip out the number. It actually happened. The most important thing, I think, however, is what happened to their automotive business. It is in the tank. And so on a sequential basis, I mentioned 22% year over year. On a sequential basis, revenues were down 16%. On a sequential basis, the automotive business was down 26%. Their biggest business, a business that is 53% of revenues in the last quarter. It was 60% of revenues in the previous quarter. So it just shows you how the contraction in that business is hurting onsemi overall. And while the automotive business is kind of leveling out here, it just wasn't strong for onsemi. So how did the stock react? Well, the stock sold off 8%, which means that for the year, the stock is down 45%. Just not good for onsemi. If you look at the last year, as I mentioned, down 45%. Now, the company really did make a focus towards making silicon carbide for the use in chargers and batteries in electric vehicles. Silicon carbide allows for a faster charge, a charge that lasts longer, and it's a shift in the industry away from silicon. But that shift is taking time. So they talked about a lot of contract wins in the quarter, but those are not coming to fruition fast enough. And indeed, their customers are sitting on lots and lots of inventory. So the question on the call, of course, is what's going to happen going forward, and what does it mean if tariffs are really going to shut down the ability to import cars made elsewhere, car parts that are all car parts, even U.S. cars, car parts are coming from all over the world, even things like my electric Jeep. I have a hybrid Jeep, and it's about 25% of the content comes from overseas, even though they like to boast that it's made in America, with some help by the rest of the world. What is that going to mean going forward? Well, onsemi CEO Hassane El-Khoury, no relation to this Cory, he's El-Khoury, but he talked about how tariffs, he just can't figure out what they're going to be and can't make any decisions, and maybe that's a problem with their business. But at least for them, while they do manufacture some chips in the US and elsewhere, they also manufacture in China.
I don't want to ponder on what the tariff could or could not be, given that just the volatility of the tariff situation one day versus the other. I will give you what we are doing, which is what we control. First off, we are in China, and we do have manufacturing in China. We have a couple of our sites, our manufacturing sites are actually in China. We do have foundry relationships. So we are not looking at China from the outside. We're looking at China from the inside. So therefore, for me, I'm not worried about the impact of it. We have a lot of 19 factories total globally. It gives us full flexibility. Most of our products are qualified in more than one location, which means from servicing the customers, whether customers in China or customers in China that will export, we are very well positioned for it. Of course, we're always looking at our strategic footprint, whether we do something specifically in China or not, but there has to be a strategic need for it, not just in reaction to a tariff that may or may not be there. So we look at it from a technology perspective. We look at it from a competitive advantage perspective. We do feel very competitive with our existing footprint, and we'll continue to address that.
So having plants in China is good when you're selling into China, but the inability to sell across borders is going to slow down their business. And indeed, if there is a continued slowdown in sales, even a recession, which could be in the cards. President Trump said he doesn't mind a short recession in America. Well, the automakers are going to mind that, and that could hurt onsemi's business. But what's it all mean? It's your big drill and earnings takeaway. So, onsemi Q1 earnings. Here's what you need, your essential summary, what you want to remember. So $1.45 billion in sales was down 22% over the previous year because customers had a lot of inventory on their old stuff. They weren't buying a lot of silicon carbide new stuff from onsemi. And the one number that tells you a whole lot, is negative 26%. On a sequential basis, this company said they could see sales down as much as 25% sequentially. It was down 26% in the auto business, and that was bad news for onsemi. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson. Follow us on all the socials at Cory TV on X, at Drill Down Pod, pretty much everywhere else. We look forward to your comments.